Today, we're going deep into Warren Buffett's 2023 letter to shareholders.
Oh yeah, this one's a classic.
We're going to try to get a real feel for what makes Berkshire Hathaway tick. How do they navigate these crazy markets?
And there's this whole Omaha effect thing.
I know, right? We'll get to that, I promise.
It's a fascinating read, because Buffett doesn't just throw numbers at you. He really tries to explain the thinking behind those numbers.
Okay, so let's talk about those numbers.
Yeah.
Because right out of the gate, he throws these net earnings figures at us.
A $90 billion profit in 2021, a $23 billion loss in 2022.
And then, bam, back up to $96 billion in profit in 2023.
Right, it's a roller coaster.
It kind of makes you wonder if even Buffett knows what's going on.
Oh, he knows exactly what's going on. He's making a point about how misleading these figures can be.
Okay, so he's not trying to hide anything. He's actually saying that the way we traditionally report earnings can be, well, a bit wonky.
Exactly. And to understand Berkshire Hathaway, you have to understand how they think about earnings differently. They focus on what Buffett calls operating earnings.
So what's the difference? Give it the breakdown.
Think about it this way. Imagine you own a house, right?
Okay, got it. Beautiful house, white picket fence, the whole 9 yards.
And the market value of that house fluctuates every day, up and down, based on what people think it's worth. But those fluctuations don't really matter unless you're actually selling, right?
Yeah, that's true.
Yeah.
I don't panic every time Zillow sends me an updated estimate.
Exactly. That's kind of like operating earnings. They strip out those unrealized gains and losses from the stock portfolio, which can be super volatile, based on what the market's doing on any given day. Instead, they focus on the actual operating profits of the businesses they own.
Makes sense. So we're not talking about hypothetical gains or losses on paper. We're talking about the cold, hard cash that the businesses are generating.
You got it. So instead of those wild swings in net earnings we see with a lot of companies, Berkshire's operating earnings are climbing steadily, $27.6 billion in 2021, $30.9 billion in 2022.
And $37.4 billion in 2023. Okay, that makes me feel a lot better as an investor.
It should. It's a reminder that you got to focus on the fundamentals, not get caught up in the market noise.
And this isn't some newfangled idea from Buffett, is it?
No way. He's been preaching this long-term investment philosophy since, get this, 1942.
1942, seriously. That's incredible. Over 80 years of experience telling us to chill out and focus on the long game.
Exactly. Don't try to time the market. Don't chase fads. Invest in businesses that are built to last.
Okay, so how does Berkshire decide which companies to invest in? How do they spot those businesses that are built to last? What's the secret sauce?
They look for companies with good economics.
Good economics. Sounds simple enough, but I bet there's a lot more to it than meets the eye.
Oh, absolutely. It's not just about looking at a company's profit margins. You have to dig deeper.
So what are they looking for? What are some of the signs of good economics that Berkshire homes in on?
They want companies that are essential, companies that play a vital role in our lives, companies that can consistently reinvest their profits at high rates of return.
So it's like planting a money tree that just keeps growing bigger and stronger.
That's a great analogy. Think about companies like Coca-Cola, or Apple, or maybe even a railroad company.
Those businesses that aren't going away anytime soon?
Exactly. And Buffett talks about railroads specifically in his letter, highlighting BNSF, which is one of Berkshire's biggest subsidiaries. But here's the thing about businesses like railroads. They require massive amounts of capital to maintain and upgrade their infrastructure.
Yeah, I can imagine. Tracks, trains, signals.
Yeah.
It all adds up.
BNSF has spent a whopping $22 billion over the past 14 years just to keep things running smoothly.
$22 billion. That's a lot of cash, just for upkeep. Makes you think twice about investing in a railroad.
It's definitely something to consider. Some businesses are just naturally more capital intensive, and that impacts their potential returns.
Okay, so it's not just about finding companies with good economics. There's another big piece of the puzzle that Buffett always talks about, right? The people.
You got it. Buffett emphasizes the importance of able and trustworthy managers.
Because even the best business model can be ruined by bad management, right?
Absolutely. He even quotes the first U.S. comptroller of the currency, Hugh McCulloch, who said back in 1863, and I quote, "I have never known a man, however bold, who, having committed one fraud successfully, did not, after a time, lose all sense of shame and become utterly reckless."
Whoa, that's a pretty dark statement, especially coming from someone way back in 1863.
Yeah, it's a reminder that human nature hasn't changed much when it comes to greed and deception.
So how do you judge someone's character? How do you know if they're truly trustworthy? Seems like a tough thing to do.
It is, and even Buffett admits it's more of an art than a science. He spends a lot of time getting to know the managers of the companies he invests in, looking for those signs of integrity, competence, and that long-term vision.
Because at the end of the day, you're not just investing in a company, you're investing in the people running it.
Yeah.
But let's face it, Berkshire Hathaway is a massive company. I mean, we're talking $561 billion in net worth.
It's huge.
Doesn't that make it harder for them to find companies to invest in? I mean, they're like a giant whale trying to find enough plankton to eat.
It's definitely a challenge. Buffett compares Berkshire's net worth to the combined net worth of all the other 499 companies in the S&P 500.
Wait, so one company's worth more than nearly 500 other companies combined? That's crazy.
Right, so they can't just sprinkle a few million here and a few million there like some smaller investors might do. They need to make big bets to move the needle.
So how do they do it? How do they find those whale-sized opportunities?
They have a few advantages, one of the biggest being they are patient. They're not chasing trends or trying to time the market. They're content to sit on their cash and wait for the right opportunity to come along.
That must be tough in today's market where everyone wants to be in on the next big thing, like yesterday.
It is, but that's what sets Berkshire apart. They're not afraid to be contrarian. They're not afraid to zig when everyone else is zagging. And that brings us to one of the most interesting parts of the letter, how Berkshire Hathaway is uniquely positioned to capitalize on market downturns.
Okay, this is where it gets really interesting. So they're not just riding the waves, they're actually waiting for the storm to hit.
In a way, yes. They don't try to predict when those downturns will happen. They just stay ready to act when everyone else is panicking.
So while everyone else is heading for the lifeboats, Berkshire is suiting up in their scuba gear, ready to dive in and grab the treasure.
Exactly. They have this massive war chest of cash, what Buffett calls dry powder, and they can deploy it quickly when markets freeze up.
So when everyone else is selling, Berkshire is buying.
Often, yes. And they have a long history of doing this successfully.
I'm starting to see why people call Buffett the Oracle of Omaha. He's not predicting the future. He's just recognizing that markets go up and down, and he's prepared for both.
Exactly. It's not magic, it's discipline. And it's a stark contrast to what Buffett calls the casino-like behavior you see on Wall Street, where everyone's obsessed with short-term gains and quarterly earnings reports.
It's like they're playing a different game altogether. Berkshire's playing chess while everyone else is playing roulette.
That's a great way to put it.
Okay, I'm blown away. I think I'm starting to grasp their strategy and why it works. But now I'm even more curious about the specific companies they're invested in. Tell me more about those good economics companies.
Oh, you're going to love this next part. We're going to dive into some of Buffett's favorite holdings, like Coca-Cola and American Express.
Two iconic brands. But what makes them so special in Buffett's eyes?
We'll get to that, and we'll also unpack some of Berkshire's more recent moves.
I'm hooked. I can't wait. Okay, so we're talking good economics companies. I mean, Coca-Cola and American Express, these are like household names. What makes them so special in the eyes of Warren Buffett?
They're the perfect examples of what he looks for. Businesses that are really woven into our lives and have this proven track record of adapting and thriving for decades, centuries even. Coke was founded in 1886.
Wow.
And American Express even earlier in 1850.
That's like before the Civil War.
I know, right? They've seen it all, these companies.
They must have gone through some crazy changes.
Oh, absolutely. And yet they haven't just survived, they've become global giants. Beverages, financial trust, these are pretty fundamental human needs.
Yeah, I can't imagine a world without a Coke or, needing a credit card at some point.
Exactly. And both Coke and American Express, they've built these powerful, enduring brands around those needs.
It's like they're almost a part of our collective, consciousness.
Yeah, you can find a Coke pretty much anywhere in the world.
And American Express is synonymous with financial security. And what's amazing is that Buffett isn't constantly trading these stocks like some day trader. He talks about this Rip Van Winkle slumber with these stocks, holding them for over 20 years.
Right. He's not trying to time the market. He's in it for the long haul. And it pays off.
How so?
Well, by holding these companies for the long term, Berkshire has benefited from both increased earnings and all those juicy dividends.
So sometimes the best move is to just do nothing.
Pretty much. You let the power of compounding do its work.
I'm starting to get this whole patience thing now. But Buffett does shake things up sometimes. He mentions a couple of newer investments in the letter that caught my eye.
Oh, you mean Occidental Petroleum and those Japanese trading companies?
Yeah, those. They seem a little different from Coke and Amex. What's the story there?
Well, these show how Buffett's always adapting. Occidental, it fits in with his interest in U.S. energy independence, which has become super important. Remember the shale boom back in 2011?
Vaguely. I'm not really an energy expert.
It basically unlocked all these huge reserves of oil and gas here in the U.S., really boosting domestic production and making us less reliant on foreign oil. Occidental, they're a big player in that. They have all these holdings in U.S. oil and gas fields.
Okay, so it's a bet on American energy, but didn't he also mention something about, like, carbon capture technology?
You're sharp. Occidental is actually a leader in carbon capture, which aims to trap carbon dioxide emissions from those power plants and industrial facilities.
Ah, so it's about storing them underground, right. I've heard about that.
Exactly. And that's super important when we're talking about climate change and trying to move to a cleaner energy future.
So it's a bet on energy independence and environmental responsibility at the same time.
You got it. It's a pretty smart move.
Now, those Japanese trading companies, what's up with those? Those sound kind of mysterious.
They are interesting. Itochu, Marubeni, Mitsubishi, Mitsui, Sumitomo.
Whoa, slow down. Too many names.
Okay. They're basically massive conglomerates with their hands in everything.
So kind of like mini Berkshires, in a way.
You could say that. They're in energy, mining, food, retail, you name it.
Okay, that's a lot. So why is Buffett interested in those?
One thing he really likes is their commitment to shareholder-friendly practices.
And he thinks they do it better than a lot of U.S. companies.
That's what he says in the letter.
Interesting. So it's diversification, global reach, and a potentially different way of thinking about shareholder value.
Exactly. And Buffett's pretty excited about these, but, not every investment is a home run.
Right.
And Buffett's really upfront about the challenges that Berkshire's faced, especially with two of their biggest subsidiaries, BNSF and BHE.
Ah, right, the railroad and the utilities companies. We talked about BNSF's huge infrastructure costs, those $22 billion. But what other issues are they dealing with?
Well, railroads, they're capital intensive.
Yeah, big time.
And beyond the costs, there are all these inherent challenges in the business itself. Think about it. They're hauling freight across vast distances, dealing with weather delays, complex labor relations, and they face a ton of regulations because they're a common carrier.
Wait, common carrier. What does that even mean?
It means they have to transport goods for anyone who wants to ship something on their lines, even hazardous materials.
Oh, wow. I didn't know that.
They can't pick and choose their customers. They have to provide a public service, which comes with a ton of responsibility.
So it's not just about moving stuff around. It's a lot more complicated than I thought.
Right. And those $22 billion in infrastructure costs start to make more sense when you consider all of that.
Yeah, for sure. But still, railroads seem like pretty stable businesses. You always need to move goods around the country, no matter what's happening in the economy.
You'd think so, right? But BNSF's profit margins have actually been shrinking in recent years.
Really?
Yeah, especially compared to other big railroads. Buffett blames this partly on increased competition,
Makes sense.
but also on all those inherent challenges we just talked about.
So even a seemingly rock-solid business like a railroad can face headwinds.
It's a reminder that nothing's guaranteed.
Now, how about BHE? What's happening in the utilities world? That's always seemed like a super safe bet.
Well, this is where things get interesting and a little bit scary.
Oh.
Utilities, they're essential services. They operate in these heavily regulated environments. They used to be seen as the ultimate safe investment.
Right, the classic widows and orphans stock.
Exactly. But that's starting to change.
What do you mean?
There's a lot of uncertainty around regulation these days. Utilities have traditionally operated under this fixed but satisfactory return model.
So they can charge rates that cover their costs and make a reasonable profit.
Right. But that model is being challenged in some states.
Why?
People are worried about rising energy prices and the push to transition to cleaner energy sources. It's like they're getting squeezed from both sides.
Oh, I see. They need to invest in all this expensive new technology to reduce their carbon footprint, but they're also facing pressure to keep rates low for consumers.
Yeah, it's a tough spot. And then you add in the rising cost of natural disasters.
Like those wildfires in California, you mean?
Exactly. They can really disrupt operations and cause huge losses.
So even utilities, which have always seemed so safe and predictable, they're facing a whole new set of risks.
Right. It's a reminder that the future is, well, unpredictable.
And even Warren Buffett and his team, they didn't see all of this coming.
Well, he admits that they didn't fully anticipate these challenges, but they're learning from their mistakes. And it kind of makes me feel better knowing that even the Oracle of Omaha isn't perfect.
He's human after all. But how did they plan to deal with all this uncertainty? What's their safety net?
That's a great question, and it leads us perfectly into the next part of Buffett's letter. He talks about diversification and the role that insurance plays in Berkshire's strategy.
Okay, insurance. Not exactly the most exciting topic, but I'm ready to be surprised.
Oh, you will be. Insurance is actually a key piece of the Berkshire puzzle.
All right, let's dive in. Okay, insurance.
Yeah.
I'm ready to learn why this is the secret sauce for Berkshire.
Oh, it's more than just secret sauce. It's like the foundation of the whole operation. Buffett says it's the core of Berkshire's well-being and growth. And it all boils down to this magical thing called float.
Float. Okay, now you've got my attention.
Think of it like this. You're running an insurance company, right?
Right.
You collect those premiums from customers up front.
Got it.
But you don't pay out claims until later, sometimes way later.
Makes sense. Gotta have the money when those claims come knocking.
Exactly. So in the meantime, you've got all this cash sitting there just waiting to be put to work. That's the float. And what does Berkshire do with it?
They invest it, right?
You got it. And over decades, they've built up a float of, get this, $164 billion.
$164 billion? Geez, that's more than some countries' entire economies.
It's like having this giant interest-free loan that they can use to buy companies and make even more money.
I'm seeing the appeal now. This float thing is pretty powerful stuff.
It is. It's like a giant flywheel that keeps spinning and generating more and more momentum.
But there's got to be a catch, right?
Well, the catch is you got to be really, really good at managing risk.
Yeah, you can't just be handing out insurance policies like candy.
Nope. You got to know what you're doing. You have to carefully assess the risks, make sure you're not taking on too much exposure.
So what's Buffett's secret? How does he make sure Berkshire's insurance operations are run right?
He's learned some big lessons over the years. The biggest one, avoid optimists when you're hiring underwriters.
Wait, really? I always thought optimism was a good thing.
Generally, yes. But when it comes to insurance, optimism can lead to some really bad decisions.
How so?
Well, optimists tend to underestimate the likelihood of bad things happening. They might offer lower premiums just to get the business, but then, bam, claims start pouring in.
Ah, I see. You need someone a little more cautious, maybe even a bit pessimistic, to balance things out.
Exactly. You need someone who's good at spotting the potential downsides, someone who's comfortable saying no to a risky deal, even if it means leaving some money on the table in the short term.
It's about protecting the long-term health of the business, not chasing those quick profits.
Exactly. And that's a theme that runs through everything Berkshire Hathaway does. They're in it for the long game, and that's reflected in their insurance operations, too.
Okay, I'm starting to see how insurance fits into the bigger picture. It's not just a side business, it's a core part of their strategy.
Right. It's a way to generate these huge sums of cash so that they can then use to invest in other businesses. It's brilliant.
It is. But like you said, it all comes down to having the right people at the helm.
Absolutely. And Buffett gives huge credit to Ajit Jain, who's been in charge of Berkshire's insurance operations since way back in 1986. He calls him a superstar and says he's put together this incredible team of insurance executives.
So it's not just about having a great strategy. It's about having the right people to execute that strategy, people you can trust.
Couldn't have said it better myself. And that's a lesson that applies to any business, not just insurance giants like Berkshire.
That's true. Well, wow. This has been an incredible deep dive. I feel like I have a much better understanding of how Berkshire Hathaway thinks and operates.
Me too. And you know, what's so great about Buffett's letters is that they always offer insights that go beyond just investing.
Yeah, he's not just talking about numbers. He's talking about life, about business, about making a positive impact on the world.
Right, and this letter's no exception. He talks about the importance of education, the power of lifelong learning, and the need to give back.
He's a big believer in using your wealth and influence to make a difference.
Absolutely, and it's not just about writing checks. It's about being thoughtful, strategic, and finding ways to have a real impact.
Well, I'm inspired. This deep dive has given me a lot to think about, not just about investing, but about how I approach business and life in general.
Me too. And I think that's the power of learning from someone like Warren Buffett. He's not just a brilliant investor, he's also someone who's deeply thoughtful about the world and his place in it.
Well said. Well, folks, that's a wrap for our deep dive into Warren Buffett's 2023 letter to shareholders. Thanks for joining us.
It's been a pleasure.
And remember, keep exploring, keep learning, and never stop asking questions. Until next time, happy investing.